Hello students, this is Sonette Smith and this is Companies Lecture 3, that's Chapter 8. These are my contact details. If you want to get hold of me during the holiday period, the best thing to do is send me an email. I do read my emails most days, so if you want to ask me a question, please send me an email. The learning outcomes that we've had so far for companies in the first two lectures is we looked at the different types of business entities, that was sole traders, partnerships and companies. We did an introduction to companies and we did the accounting entries for the issue of shares. We also looked at how to account for the conversion of par value shares into no par value shares, as in terms of the New Companies Act, all shares that are now registered are registered as no par value shares. We looked at disclosure, the note for share capital, as well as how we disclose equity in the statement of financial position and how we disclose share capital in the statement of changes in equity. In the textbook, we've already covered page 213 to 224. And the questions that you're able to do after the first two lectures are question 81, 82, 83, 84, 89, 10, and 11. So the learning outcomes for this lecture are the following. We're going to account for company tax or corporate tax. We're going to do transfers to and from other components of equity, and we'll discuss what that means. And we're also going to calculate and account for dividends on different types of shares. So we're looking at Chapter 8 today, pages 225 to 230. And the questions we're going to look at today are questions 85 and 86. So the first thing we're going to talk about is income tax. A company is a taxable entity. That means it pays tax in its own right. Remember, in a sole trader and a partnership, the owners pay the tax that's owing because of what profit the business has made. Now the company is its own separate legal person, and therefore it is its own taxable entity. The current tax rate for companies is 28%. So whatever taxable profit a company makes, 28% of that needs to get paid over every year as taxation. What companies have to do is they're not allowed to only pay their taxes once a year. They have to actually make provisional tax payments, which means that they're going to have to pay taxes more than once. They've got to make two payments during the year. So the first payment is after the first 6 months of the financial year, and the second payment is at the end of the financial year. So companies make two payments during the current year, and then their last payment they make after the end of the year once they finally know what tax is paid. So these provisional tax payments are actually advanced tax payments companies are required to make. So we're going to use example 8.4 to explain how we calculate tax and how we do how we work out how much tax is still owing at the end of the year for a company. So we've got the example here of Exemplar Limited, and it tells us that in the prior year they had taxable income of 92,860. That's in the previous year. Now they've made two provisional tax payments in June and December 2013. So this is the current year. When you make provisional tax payments, you always make these tax payments based on your last taxable income amount. So the tax payments would be calculated as 92,860 times 28%. That should be percent. And that gives us 26,000 is the tax owing on 92,860. We divide that by 2 and we make one payment in June and we make another payment in December. So this company paid 13,000 in June and 13,000 in December. So the journal entries for the payments are: we debit SARS income tax liability account. SARS stands for South African Revenue Services. This account is a liability account. What's happening with this payment is we are prepaying the liability. So we debit the liability account and we credit bank. And we do the same thing in December. We debit SARS income tax liability and we credit bank. Okay, so these payments, these provisional tax payments, are advance payments for the 2013 year, and we've made those advance payments based on the taxable income that we earned in the prior year. Now they tell us that the tax expense for the current year, that's the 2013 year, amounted to 30,000 Rand. So the 30,000 Rand is our actual income tax expense that we're going to show as an expense for the year, and that's the actual amount that we owe on the liability. So we're going to credit the SARS income tax liability account with 30,000 Rand. Now if we look at the SARS current tax payable account, this is the liability account. On the debit side you'll see the two prepayments of 13,000. On the credit side, you see the actual tax that is owing for the 2013 year. So this account, if you add up the credit side as a balance of 30, and then if you subtract the two payments we've already made, it means we're left with a balance of 4,000. So that 4,000 at the end of December 2013 is the amount for tax for the year that hasn't yet been paid. This account could be an asset or a liability. In this case, it's a liability because we've underpaid our tax. If these two payments here had been more than 30,000 Rand, then we would have overpaid the tax and we would have had an asset or a debit balance. So if there's a debit balance, it's an asset. If there's a credit balance, it's a liability. What will happen is the final tax payment will need to be made to SARS for that 4,000, and it usually is due 6 months after the end of the financial year. So in this case, that would be 30th of June 2014. So that 4,000 Rand is simply the 30,000 tax that's due for the year minus the two provisional tax payments that have been made. So when we make the payment, we credit bank and we will debit the income tax liability account. This income tax expense is the amount that's then going to be shown on the statement of profit and loss. Let's look at another example. In question 8.6, we are going to journalize the income tax expense for the 2003 year, and then we're going to do accounts in the general ledger. We're going to do the current tax payable account, which is your liability account, and the income tax expense account for the year. Okay, so the year ends on the 31st of December and the provisional income tax payments for the 2003 year have been made. At the 30th of June we paid 43,200 and on the 31st of December we paid 38,620. So in a question we might either tell you how much the provisional tax payments are, otherwise we'll give you the prior year taxable income as you saw in the example we just did, and then you have to work out what the provisional tax payments would be for the next year based on the prior year's taxable income. So in that question, remember, we took the prior year taxable income, multiplied it by 28% and divided by 2. In this case, there probably was tax assessed during the year, which is the reason why the two tax payments are different. But you don't have to worry about that. If they are different like this, we will give you the amounts. You won't need to calculate them. Then the profit for the tax year ended 31st of December 2003 is 320,000. The company's corporate income tax rate is 28%. So the first thing we're going to do is calculate the income tax expense. That's going to be based on the 320,000. Then we're going to do the two accounts, the current tax payable account. So then we're going to work out how much tax did we owe and how much tax have we already paid to see what's still owing at the end of the year. So the entry for the income tax expense, we have to take the 320,000 taxable income multiplied by 28%, that gives us the tax expense for the year of 89,600. So we'll debit the income tax expense account and credit current tax payable, or the SARS account, which is your liability account. So this 89,600 will be debited to income tax expense and credited to current tax payable. The two provisional tax payments during the year at 30th of June and 31st of December would have been credits to the bank account and debits to the current tax payable account. Now, to work out the balance that's still owing at the end of the year, you just take the 89,600 and you subtract the two payments you've already made, and you end up with the amount that's still owing. And in this case, there's a liability tax that's still owing for the 2003 year, and that tax would need to be paid 6 months, within 6 months of the next financial year, by the 30th of June 2004, in other words. Okay, so that's how we simply do the calculation for income tax expense and current tax payable. Apart from this, the only other thing that you're still going to see later on in these lectures is exactly what this looks like on the statement of financial position and the statement of profit and loss. Current tax payable will normally be shown as a current liability. If this tax was an asset, in other words, we prepaid tax, it would go as a current asset, prepaid expenses. Now we're going to talk about appropriation of profits in terms of dividends. Remember what we said: when we form a company, the company will make profits and retain the profits in the business, in the company as an entity. And if the company decides, it can pay dividends to the shareholders, but it doesn't have to. Dividends are what we call an appropriation of profits. That means a using up of profits, but it's not a normal expense, because the business has already made its profits, and this merely is an allocation of those profits to the owners. When we pay, or when we work out a dividend rather, we give dividends based on the issued shares at the date that we declare the dividend. This can be any date that the directors decide. It could be the year-end date, but it could be any other date. So at that date, whoever has shares that they own at that date, their names are in the share register as the owner, they're the ones who will be entitled to the dividend. We're going to record the dividends when they are declared using the accrual principle that we use for all expenses. But remember, however, this isn't an expense, it's an appropriation of profits. It's going to go on the statement of changes in equity, which we'll show you in another later on in this lecture as well. So at the point when we declare the dividend, even if we haven't paid the dividend, we will accrue for it. So the accounting entries for dividends will look like this. On declaration, we will debit dividends on ordinary shares. This is an appropriation amount, which, as I said, is going to be on the statement of changes in equity. It will reduce retained earnings. Then we'll credit shareholders for dividends, which is a liability amount for 500 Rand. So as I've said, the 500 Rand will be deducted from retained earnings in the statement of changes in equity, and the other 500 Rand here for shareholders for liabilities will be shown as a current liability in the statement of financial position. Then when we make the payment, we will merely pay this account, the shareholders for dividend account. We'll settle it, and the credit side of the entry will be to bank. Question 8.5 also deals with dividends. So in this question, we're going to do a calculation first of all of dividends payable for the company for the year ended December 2006, and we're going to journalize the dividends that were declared on the 20th of December 2006. So let's read the question. On the 31st of December 2005, so this is the end of the prior year, the beginning of current year, this company had 300,000 ordinary shares with no par value. The total amount they'd received for those shares is 450,000 Rand. they had 60,000 cumulative preference shares of no par value. The total amount they'd received is 120,000 Rand. Now, cumulative means that these shareholders will get their dividend, and they are entitled to a fixed annual dividend of 24 cents for every share that they own. So for every share that they own, they will get 24 cents, and their cumulative preference shares means those dividends accumulate. So if in 1 year they don't get paid, they will get paid them in the next year before anybody else gets a dividend payout. So these shareholders have dividends that are cumulative. That means they never forfeit their dividends. They always accumulate and get paid out to them when the company can afford. The last type of shares they have is 40,000 just ordinary preference shares of no par value that they issued for 72,000 Rand. These shares have a fixed annual dividend of 18 cents per share. So that means every share is going to get 18 cents as a dividend. These are preference shares, so they will get a dividend before the ordinary shareholders do, but they're not cumulative, which means if in 1 year they don't get their share, that share will fall away and it won't accumulate. Preference shareholders, however, will always get their dividend before ordinary shareholders do. The preference shares are all non-redeemable. That means the company has made no arrangement to pay them back, which means all of these shares are equity. These shares were issued on the 1st of September now, so we've now got additional shares that were issued. 100,000 ordinary shares were issued at 2 Rand and 20,000 preference shares were issued at 1.80 Rand each. On the 20th of December 2006, the directors declared a preference dividend and a dividend of 8 cents for ordinary shares on all the ordinary shares that were issued on the 25th of December. So that would be the 300,000 ordinary shares here, plus these 100,000 ordinary shares, because they were already issued on the 1st of September, and they would all be in issue at this date, the 25th of December. They also tell us there are no preference dividends in respect of prior years that are outstanding. In other words, these cumulative dividends are up to date. These cumulative preference shareholders have received their dividends up until the end of the prior year. They just now need to receive dividends for the year that we're busy with, December 2006. So let's look at how we do the calculations. The first thing is that we need to just realize, I'm just going to say for you, the first dividend that must be paid is to the cumulative preference shares. So there were 60,000 cumulative preference shares that each get a dividend of 24 cents. Please note this is not the Rand value, this is the number of shares. So that means the dividend on cumulative preference shares must be paid 14,400. Then we will pay the dividends that are due on the normal preference shares. So at the beginning of the year we had 40,000 preference shares that were held by preference shareholders. They each get 18 cents per share. Again, this is not a Rand value, this is the number of shares in issue. So that gives us 7,200 Rand. For the shares that were issued on the 1st of September, there were 20,000 preference shares issued at that date. They each get a dividend of 18 cents. But for the preference shares, we actually are going to apportion the dividend because these preference shares were only held from the 1st of September to the 30th or the 20th of December, which is basically roughly 4 months. So it means they're only entitled to a dividend for 4 months. Please note this is only for preference shareholders, where you will apportion the dividend based on the number of months for which they held the shares. So that dividend will be 1,200. For the ordinary shares, we have 2 sets of shares, the 100,000 issued during the year plus the 300,000 that were issued at the beginning of the year, giving us the total of 400,000. Anyone who owned a share on the 20th of December will get this 8 cents dividend. So if we take 8 cents times 400,000 shares, we get dividends of 32,000 Rand. So for ordinary shareholders, what happens is when you buy or sell ordinary shares, the purchase price that you pay or the selling price that you sell it at normally takes account of the fact that a dividend has just been paid or a dividend is about to be paid, and it affects the price. But when the company actually pays the dividend, it gives all ordinary shareholders who own shares the same dividend, even if they haven't held the shares for the whole year. Whereas with preference shareholders, you must apportion it if it wasn't held for the whole year. So we'll debit dividends on ordinary shares, and remember I said this is an appropriation of profits, which will get shown on the statement of changes in equity, and we'll debit dividends on preference shares. The total dividends on preference shares are 22,800. We will credit shareholders for dividends, which we said are a current liability. At the end of the year, we owe shareholders 54,800. So when we pay them in the next year, we'll merely credit bank and debit the shareholders for dividends account. We will see more of this as we go through the company's questions and company's lectures now, but this is the basic knowledge that you need for how dividends are calculated and accounted for. We also need to tell you about other transfers to and from equity. So profits after tax are the profits that a company has been made after they've given SARS their 28% share. The directors of the company can choose to take some of those profits and set them aside for a specific purpose other than for dividends. This, for example, might be if they want to set money aside for replacement of outdated assets, then they'll create an asset replacement reserve. It will still be part of equity, and they can still transfer it back to retained earnings later on and distribute it to shareholders. You will see an example of this just now, but basically what happens is you have your profits, and instead of giving your profits as dividends, you set some of your retained earnings aside into a separate reserve account, which is part of equity. And that reserve account, we decide that we will not and cannot pay dividends out of that account because the company needs to retain that in the business for replacement of assets in the future. But we can transfer it back to retained earnings later on and give it to the shareholders as a dividend, but these decisions are all made by the directors normally. So the retained earnings of a business are the cumulative profits or loss that the company has made, and they are available to be paid out as dividends to shareholders. They are retained earnings is part of equity, so normally if it's a cumulative profit, it increases equity. And the transactions which can affect retained earnings are the following. We could have a profit or loss for the year after tax. That's the first transaction that affects retained earnings. The profit or loss for the year gets added to the cumulative profits or losses. We could make a transfer of retained earnings to an asset replacement reserve. We could also pay out or declare dividends that would come out of retained earnings. And as I said, you will see this in examples as we go along. So in equity, retained earnings is the accumulated profits of the business, which are profits after tax, and those profits can be used to pay out dividends. Otherwise, the directors might make a decision to set aside some of the profits in a separate reserve, which then will not be used for payment of dividends. I want to finish this lecture by just showing you a statement of changes in equity again. We will be doing an example in the next lecture where we actually put the statement of changes in equity together. But let's just look at question 8.8, statement of changes in equity in the meantime. This is the statement of changes in equity. That company had a 28th of February 2003 year end. And there is a column here for all of the elements that are in the equity section of the statement of financial position. So the ordinary share capital is here, retained earnings are here, revaluation reserve and asset replacement reserve. For the ordinary share capital, we normally always have to show the balance of ordinary share capital. This is in rands at the beginning of the year, any shares issued during the year, and the balance at the end of the year of ordinary share capital. Remember, we also have a note giving details about the balances of share capital at the end of the year. In the retained earnings account, we will start with an opening accumulated balance. We'll have our comprehensive income for the year, which in this question is just your profit. These are not two amounts. These amounts here together add up to the total comprehensive income. So in this question, the two are the same. So in fact, if it makes sense to you, you can just take that out of this question because it doesn't get added twice. This 129,600 is the profit for the year after tax that gets added to the opening balance of retained earnings. Then there's the dividend that gets paid out, and then finally there is 15,000 Rand that's getting taken out of retained earnings, and the debit is going to go into an asset replacement reserve. So we've got in this question also then, let's just finally look at the closing retained earnings balance. So in this question 8.8, the retained earnings, we had the opening balance, the profit for the year, a dividend paid out, and a transfer to the asset replacement reserve. We're going to look at the revaluation reserve in the next lecture. For the asset replacement reserve, we had an opening balance of 30,000. That would have been in equity at the beginning of the year, the end of the prior year. In this year, we transferred 15,000 out of the retained earnings into asset replacement reserve. In your statement of changes in equity, all of these amounts are credit balances. So if you see an amount in brackets, it means that's a debit. So in the retained earnings column, dividends are debited. The transfer to reserve, we debit retained earnings, and we will credit asset replacement reserve. So when you see an amount without brackets, that's because it is a credit amount. So there would have been a journal entry here, debit retained earnings, credit asset replacement reserve with 15, which would increase the asset replacement reserve to be 45,000 Rand at the end of the year. We will look at question 8.8 in more detail in the next lecture, which is lecture 4. This total amount here of 722,600 is the total of all the different components of equity. At the end of the year, this is what the business is worth to the owners. It's made up of their share capital plus their retained earnings plus their revaluation asset replacement reserve. So that's the wealth that's been built up in the company for the owners. So that's the end of this lecture. We looked at company income tax, we looked at how to calculate dividends, and we looked at retained earnings and other transfers to asset replacement reserve. In lecture 4, we're going to look at pages 231 to 236 of chapter 8, and we're also going to do part A to C of question 8.8.